Welcome to Breaking News to Trading Moves. The headline we are examining today is exactly this. Oracle earnings put the AI cloud trade on trial.
Yeah, and if you just think about that for a moment, I mean, Oracle used to be seen as, the sleepy legacy database provider of the 1990s.
Right, exactly. And now, well, they kind of hold the keys to the entire artificial intelligence infrastructure boom. We are looking at a market where Oracle, trading under the ticker ORCL, has just rallied relentlessly.
Which is mostly based on expectations around Oracle Cloud Infrastructure, OCI as we will call it today.
OCI and their ability to secure these massive AI computing contracts. So the central question we are debating is, which specific market sectors face the most direct consequences from Oracle proving its earnings, its profit margins, and its forward guidance can actually support this valuation?
And we come at this from pretty different angles.
We do. From my perspective, the focus belongs squarely on the direct hardware. I am looking at the chip manufacturers and, the physical data center operators directly tied to Oracle's performance.
Yeah, and I come at it from a completely different direction. While the hardware is obviously a factor, focusing only on the metal is, well, I think it is missing the forest for the trees. My focus is on the broader cloud competitors and the traditional software companies.
The software side.
Right. They are the entities that stand to win or lose based on market mechanics, specifically capital rotation and the reality of enterprise budgets. Because, if Oracle proves this trade is real, the money to fund it has to come from somewhere, and it will be drained directly from legacy software.
Okay, well, let me establish the physical reality first, because the most direct application of Oracle's earnings lies right there in the hardware, the compute layer.
Go ahead.
If Oracle reports strong OCI growth and signals confident, aggressive demand, they are the immediate winner. The market is finally pricing ORCL as a top-tier cloud platform. But the derivative winners, the companies making the actual tools for this gold rush, are the chip makers.
Sure, Nvidia.
Exactly. Nvidia, ticker NVDA, and Advanced Micro Devices, ticker AMD. They are positioned to benefit directly because they design the very engines running these data centers. And, you cannot ignore Broadcom, ticker AVGO.
Right, for the networking.
Yeah, because you can buy 10,000 GPUs, but if they cannot talk to each other at light speed, they are useless. Broadcom provides the networking fabric and custom silicon that makes a server cluster function as a single brain. The way I frame this is by comparing it to the foundation of a skyscraper. Before you can ever evaluate the tenants, which are the software companies, you must ensure the concrete and the steel are holding up. The chips and the networking gear are the concrete and steel of this entire market.
Well, I understand the foundation metaphor, but I think it fails when applied to the actual stock market.
How so?
Because inspecting a foundation implies a cooperative building process where everyone wins. The market is a zero-sum game for capital allocation. You are obsessed with the concrete and steel, but I am looking at the interest rates on the mortgage.
Ah, I see.
Yeah, if the money dries up, the construction stops immediately, regardless of how good the blueprints are. Oracle's success comes directly at the expense of other established players. Just look at the larger cloud platforms. Microsoft, ticker MSFT, Amazon, ticker AMZN, and Alphabet, ticker GOOGL.
But, wait, they are all buying the exact same hardware.
Exactly. They already spend billions on chips and data centers. Strong Oracle numbers certainly confirm general demand for those chips, but simultaneously, they raise immediate questions about pricing power for those larger rivals.
Right, the margins.
Yes. If Oracle becomes a highly competitive, lower-cost alternative for AI workloads, well, MSFT, AMZN, and GOOGL face direct pressure. Their profit margins are tested the exact moment Oracle proves it can capture enterprise contracts at scale. The big three suddenly have to spend just as much on Nvidia chips, but they have to charge their customers less to keep them from fleeing to Oracle.
Okay, I see why you want to focus on the pricing war between the hyperscalers, but let me pull us back to the mechanical bottleneck if I can.
Sure.
Let us talk about the actual physical requirements of housing those chips, because that is where the real constraint lies. The material makes it clear that Oracle's growth depends entirely on physical data centers. When you pack thousands of these new processors into a server rack, you are essentially creating an industrial oven.
Right, the thermodynamics problem.
Precisely. The power draw is immense. More servers necessitate more cooling, specific grid upgrades, and, well, enhanced power supply. This is a purely physical constraint that software pricing models just cannot solve. So you have Vertiv, ticker VRT, and Eaton, ticker ETN. These companies are directly tied to the liquid cooling and power management required for high-density compute. I mean, a standard air-conditioned room cannot cool these new clusters.
No, they need direct-to-chip liquid cooling.
Exactly. Then you look at the electrical grid. You have Quanta services, ticker PWR, linked directly to the necessary transmission line construction. And when the local utility simply cannot provide enough megawatts, you have Bloom Energy, ticker BE, positioned to step in with fuel cells for off-grid or supplemental power generation.
Okay.
These are the mechanical requirements. If Oracle puts up a strong print, it proves they are successfully navigating these physical bottlenecks, which validates VRT, ETN, and B.
Okay, but let me push back on that sequence of events. You are mapping out the cooling and the grid upgrades perfectly, but those physical data centers only matter if enterprise AI budgets hold strong at the very top of the funnel.
Well, sure.
Corporations do not buy electricity and cooling liquid for the fun of it. A strong Oracle report is simply a proxy for enterprise budget health. If I am an investor, I look directly at the enterprise data platforms and consulting firms.
Like who?
Accenture, ticker ACN, and IBM, ticker IBM. They stand to benefit because these massive projects require intense consulting and integration work. A logistics company does not know how to build a neural network out of the box. They hire IBM to do it.
But IBM still has to run that network on Oracle's physical servers.
They do, but they need the operational tools first. They need Palantir, ticker PLTR, for the actual operational implementation. And more importantly, they need Snowflake, ticker SNOW.
For the data structuring.
Exactly. You cannot execute a strategy on messy, fragmented data. If a company's data is stored in 20 different incompatible formats, an AI model will just generate garbage. Snowflake cleans and centralizes that data. If the enterprise demand at this consulting and software layer falters, the physical build-out you just described stops dead in its tracks.
Wait, how so?
Well, no clean data means no AI models, which means no need for Bloom Energy to build a fuel cell.
I get why you were looking at enterprise budgets, but I think you have the dependency completely backwards there.
How?
Can consulting and data cleaning, the services provided by Snowflake or IBM, can they even exist in a scalable way without the cooling and grid upgrades acting as the primary gatekeeper? Vertiv and Quanta services are solving the immediate physical ceiling of the industry.
But the demand has to be there first.
Sure, but it does not matter how perfectly Snowflake cleans a company's data if the utility company tells Oracle there is no electricity available to run the query. The capital must flow to the physical constraints first. ORCL proving its margins means they are actively overcoming the power constraints to deliver the compute. The software is secondary to the laws of physics.
But capital does not just materialize out of thin air to pay for all this concrete, steel, and liquid cooling. If billions of dollars are pouring into Vertiv and Eaton, it is being drained from somewhere else.
Yes, obviously.
And this brings me to the core market mechanic, which is capital rotation. If money rotates into physical infrastructure, traditional software faces a direct and immediate threat. A strong Oracle print actively harms traditional software stocks.
Because the budgets are finite.
Exactly. A chief informational officer only has so much money to spend each year. If they allocate an extra $50 million to Oracle Cloud infrastructure, they have to cut $50 million from their traditional software spend. Look at Salesforce, ticker CRM.
They have a solid narrative, though.
They present a compelling narrative, yes, but investors prefer clearer physical infrastructure exposure when ORCL puts strong numbers on the board. Adobe, ticker ADBE, faces direct disruption risk because automated tools might require fewer human design seats. Workday, ticker WDAY, and ServiceNow, ticker NOW, suffer directly if institutional money rotates out of their high multiple valuations and into AI infrastructure.
That makes sense.
The capital rotation away from software multiples into infrastructure realities, that is the defining market mechanic we have to watch here.
I agree that capital rotation is a zero-sum dynamic, but I interpret that exact mechanic as the reason Oracle is an even purer test of infrastructure over software. Your point about capital fleeing traditional software like WDAY or CRM actually reinforces my initial position.
How does that reinforce your position?
Because the market is stripping away the theoretical applications and demanding concrete returns. Oracle's OCI growth metrics force the market to price in the reality of the hardware layer. When capital abandons the software layer to chase infrastructure, it proves that the foundation, the chips, the servers, the electrical transformers, is the only trusted vehicle for capital right now. This is precisely why the physical build-out metrics are the ultimate arbiter of the trade.
Okay, but that entirely assumes the infrastructure trade always works and that Oracle's numbers will always be stellar. We must evaluate the downside risk here. What happens to your foundation if the ORCL print is weak? The market has priced these infrastructure expectations to absolute perfection.
Well, if we evaluate the downside risk, you are right. The impact on the hardware layer is immediate and severe. If Oracle misses expectations, gives cautious forward guidance, or shows capital expenditure pressure, the market will question the entire build-out premise.
Right. ORCL itself would be the direct loser, of course. But the derivative pain hits the AI server names instantly.
You mean the companies actually assembling the racks?
Yes.
Dell Technologies, ticker DELL, Hewlett-Packard Enterprise, ticker HPE, and Super Microcomputer, ticker SMCI. They face direct downward pressure. Their valuations are completely tethered to sustained aggressive server demand.
And they have low margins.
Exactly. They operate on tight margins, buying the chips from Nvidia and building the actual metal boxes. If Oracle signals that enterprise adoption is slowing or that the cost of building out the infrastructure is compressing their margins beyond acceptable limits, well, DEL, HPE, and SMCI are the first to be punished by the market. The hardware layer bears the absolute brunt of the disappointment because their inventory becomes a massive liability.
I agree, those hardware names face immediate downside in that scenario. But notice the market structure reaction. A weak print from Oracle, while devastating to DEL or SMCI, actually alleviates the competitive pricing pressure on the big cloud rivals we discussed earlier.
Wait, you think it helps them?
Absolutely. If Oracle fails to capture market share or struggles with OCI margins, the threat to Microsoft, Amazon, and Alphabet diminishes instantly. MSFT, AMZN, and GOOGL suddenly look much more secure in their oligopoly. The capital that flees the hardware names might rotate right back into the safety of those hyperscalers.
Huh.
It might even rotate back into the traditional software names like NOW and CRM, as the market realizes the infrastructure revolution might take a lot longer to materialize than previously priced. The zero-sum nature of the market works in both directions.
That is a fair assessment of how capital might seek safety in a panic. However, let us look closer at the mechanism of that downside for the hardware names. It is not just about a temporary rotation of stock ownership. It is about the entire capital expenditure cycle of the industry.
Okay.
The reason Dell and Hewlett-Packard Enterprise are so sensitive here is because their backlog is scrutinized on a quarterly basis. If Oracle guides lower on their capital expenditures, the immediate assumption is that physical server orders will drop next month. This cascades down to the chip level. Nvidia and AMD might have broader customer bases, but a reduction in spend from a major player like Oracle introduces severe doubt about the longevity of the current upgrade cycle.
Right.
If the big buyers stop buying, the chip makers have a math problem.
Well, I look at that exact doubt a bit differently. The doubt is not just about whether Oracle buys fewer servers. It is about whether the enterprises buying from Oracle are actually seeing a return on investment.
Oracle's guidance is cautious. It tells us that Accenture and IBM might be seeing delays in project implementations. It tells us that Palantir's operational integration might be facing longer sales cycles because CEOs are getting nervous about the bill. The market uses Oracle's earnings to measure the willingness of non-tech corporations to open their wallets. If the enterprise budgets tighten, the traditional software companies like Workday and Salesforce might actually maintain their current valuations.
Wait, why would they maintain their valuations if budgets are tightening?
Because the perceived threat of immediate disruption to their business models is delayed. If companies are not buying AI tools to replace human resources or sales staff, then they still need to pay for Workday and Salesforce seats. A delay in AI adoption extends the lifespan of the traditional software model.
I do not buy that for a second.
Why not?
You are assuming traditional software gets a free pass if AI infrastructure adoption slows. If Oracle misses and enterprise budgets are exposed as weaker than anticipated, the entire technology sector's valuation framework is tested. The market will not necessarily rotate back into CRM or ADBE. Institutional investors might exit the technology sector entirely in search of lower multiple stability in other industries.
That is possible, sure.
But returning to the direct consequences, the physical constraints remain. Even in a slower growth scenario, the power requirements for the existing data center footprint do not decrease. Vertiv and Eaton still have to service the high-density environments that are already built and running. Bloom Energy still has to provide power where the grid fails today. The physical demands of the current footprint provide a floor for the infrastructure names that the software companies simply do not possess.
I hear you. But the floor for physical infrastructure is only as solid as the contracts securing them. If cloud firms find themselves with excess capacity because enterprise demand softens, the orders for future-grade upgrades to Quanta services or new cooling systems to Vertiv will halt entirely. The stock market forward prices these expectations. A weak Oracle print forces analysts to recalculate the utilization rates across all data centers over the next 3 years. If projected utilization drops, the physical build-out narrative collapses just as quickly as the software narrative. This is why the capital rotation metric is superior. It tracks the actual flow of money in real time, agnostic of whether the constraint is a physical power grid or an enterprise consulting budget.
Well, we have covered a lot of ground regarding the mechanics of this trade. To summarize my position in light of our discussion, Oracle's earnings function as the ultimate litmus test for physical infrastructure, power generation, and chip demand.
Right.
The structural reality realizes entirely on the deployment of hardware and overcoming the laws of physics. The metrics we must track to validate this are exact OCI growth, the stated backlog of contracts, the capital expenditure projections, and the margins maintained while expanding. A strong print validates the physical reality of NVIDIA, AVGO, and the necessary power infrastructure like ETN.
And to summarize my perspective, the earnings report is equally a test of capital allocation. It measures enterprise budgets against traditional software vulnerabilities and tests the pricing dynamics of the primary cloud competitors. The very same metrics, OCI growth and forward guidance, inform us whether capital will continue to drain from ADB and WAD, and whether MSFT, AMZAN, and Google will face margin compression due to heightened competition.
The specific trading takeaways remain clear. Watch the OCI growth, the backlog, the CapEx, the margins, and the management commentary on AI demand closely. A strong print provides direct support for infrastructure, chip manufacturers, and data center-related stocks.
While a weak print directly hits Oracle, the server manufacturers, and applies immediate pressure to expensive software stocks across the board. The multiple variables interacting here ensure that evaluating the market requires looking beyond a single layer of the technology stack.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.